Right. Evening, everybody. I'm not going to comment on the quality of the chair I'm sitting on as opposed to the quality of the chairs the panelists are sitting on. That's the way lawyers are nowadays treated. Anyway, moving swiftly on, what I'm going to do is get the panelists to introduce themselves and say a very little about their funds, and then we will get on to the questions. Okay, so each in turn, if you'd like to introduce yourself and your fund.
Yes. It is working. Can you listen to me?
It's working.
Yes. Excellent. So my name is Pietro Bezza. I'm founder and managing partner of Connect Ventures. Connect Ventures is a seed single-stage specialist fund based here in London. We invest in a seed company. We've been close 13 investments since 2012, and 50% here in London, 50% out of London.
Great.
So I'm Joe, one of the partners at Playfair Capital. We're now done a 30-second investment last month. The geographical focus is mainly in the UK, although we have done a few in the US, one in Sweden, one in Kenya. And then got a couple of colleagues in the audience as well, Georgia over there, who's one of the other partners, and Nathan. Federico is the founding partner, but he unfortunately couldn't make it tonight.
Great, thank you. Katie.
Hi, I'm Katie. I'm from Jamjar Investments. We are the Innocent Drinks Founders Fund that focuses on consumer products and services. We'll look at online stuff and unusually offline stuff. And we have a bias towards Europe, but we will look internationally.
Luke.
So Luke Hakes, principal at Octopus, been there 6 years. So Octopus, early stage tech VC, so seed through Series B, 350 million under management, about 44 companies in the portfolio. Very happy to meet all of you.
Okay, right. Well, I think Duncan set the scene really well for this panel. And the first question to ask is, you guys, by and large, you're all in the seed stage. But as Duncan's slides highlighted, there is a shortage later on down the track. Now, question later on down the track has been pushed further down the track relative to where the companies get to. But do you see that as becoming an increasing problem within Europe? Because certainly my perception at the moment is at the seed stage, there is an increasing amount of institutional seed money alongside individual seed money. But for those companies that are going to need a big A round when they finally get to it, the number of European VCs you can probably count on your fingers nowadays. So I'd be grateful if each of you could comment on whether or not you see that as a real problem, or whether or not, because of the cost of scaling up has come down sufficiently, enough companies will get enough capital to get out without it being a barrier to growth.
Yeah, I can start. Out where? In US or out in the market?
In the US, we're talking about Europe here rather than the US.
No, yeah. So because definitely, so in terms of what we see as a Connect Ventures every day for our portfolio company,
yeah.
We have just 2 companies that were ready for a Series A because we are a very young fund. So the first investment was the cohort, which is a bad name for companies, but it's a cohort 2012. So taking 1 year as a time for be ready for the Series A, which is, by the way, it could be 1 year is kind of tough. Let's say 18 months. So we are ready now go for Series A. So far, CityMapper and Pat Coffee were able to secure Series A. I would say quite easily. But maybe I will face this kind of struggling for our portfolio company to raise Series A. And I think, yes, there is more company that raise seed and less company that can secure Series A. There is this kind of mismatch. I think it is a good and real market snapshot.
But you've got 2 companies who've both got A rounds. But
yeah.
Do you, when considering whether to invest at all, does the fact that there is a really finite amount of A round money, does that actually impact on your decision whether to invest at all at the start?
No, because we think the good company that reach the milestone can raise money.
Yeah, but in determining whether it's a good company, you include in that determination, and we think it'll get an A round.
No, no, because otherwise I would change my job, right? So we think that we were able to find good company that became good enough,
yeah,
and reach the traction that Series A investor want to see. when will be time with the money we provide them. So, but because we know there is a crunch and there is a very selective process, what we can do as a seed investor is provide them enough money, they provide enough time and the right resource to get that milestone that makes the Series A investor more comfortable to invest in the company, first. Second, we know that maybe SaaS company can have a different trajectory and different needs than consumer. We are aware that maybe there are more appetite at seed on SaaS now than consumer. So when we invest today, we think what's going to happen in 18 months. But it's indeed affect the decision more how much based on the kind of company, rather than he will be able to raise money in 18 months, right? Because if we don't think that, we just go for a bootstrapping company, which is not our job, right?
Okay. Joe, I mean, you just said you've done your 32nd investment.
That's right, yeah.
So, I mean, of those 32, how many do you think will actually need to do an A round? Are there quite a few which you're relying on actually not needing to get there to do that in order to become cash positive and
yeah, I think the vast bulk of them will actually get there. Out of 32 companies, we've only had 2 that have failed so far in 3 years. Yeah, as for whether or not there's this funding gap at the Series A stage, I think it's useful to put some numbers around that. So in the last year, there's 1.2 billion, I think, invested in London tech companies. And a lot of that's heavily skewed towards the seed stage where we're operating. And there's 300, compared to last year, 330%. There's been a 330% increase in funding at that seed stage, which is a huge, huge number. So the valuations of companies obviously increased at the seed stage. And I think there's going to be a growing trend going forwards for investors to move out of seed and go slightly up the ladder towards Series A, just because the valuations have increased so much. So because of that, there'll be more capital deployed at the Series A stage. I'm not too worried about it.
Okay. Katie?
So first, it's worth saying that Jamjar will look at seed and Series A deals. So some of our portfolio at the moment is actually Series A rather than seed. Do I think there's a problem in that there's more seed companies funded? No. I think there's a very real gap, but I don't think there's a problem because first, I trust the market. So ultimately, yes, more companies are getting funded, but at some stage, you've got to work out whether it was worth funding them and whether they're decent companies or not. So out of the system, the best companies will win. And I trust that system. And I also think if they're decent companies that come out of seed, the money will come. There's a lot of money around at seed stage. And I agree with what Joe said. The ecosystem itself will rise up and start doing later stages if there are great businesses ready to be funded. So I'm not worried.
Katie has a question saying, can you name a couple of companies that you back?
Yeah, sure. So I'll give you 2 recent examples. We've recently done a company called Cano, which is a great business. It's computer hardware for kids. So it's a computer kit that teaches kids how to code, but it's actually got a Raspberry Pi component in the kit. So that's a really exciting consumer proposition, we think, to try and teach the world about computers. Another one we did last month is called Deliveroo, which is a business that allows premium restaurants to deliver food to consumers. So the business is actually the logistics, so it's the actual bites that deliver. So, for example, they're working with Gourmet Burger King at the moment. Previously to them, Gourmet Burger King didn't deliver. Suddenly it's a way to get that food, and their clever insight is they're aggregating all the companies that don't deliver to be able to do so efficiently. So there's a couple of examples.
Luke, I mean, Octopus is in the envious position of being able to do seed through to A and beyond. So is the lack of A challenge for you? I mean, is it a problem for you? Is that maybe there are not people around to syndicate? Should you want to syndicate?
I think I'm inclined to agree with most of what Katie said, actually. For us, I don't think there's a big issue. I think last year we maybe did 20 Series A deals. I think of those deals, you know, all of them were either with a co-investor or had some competitive element, which kind of says that there are plenty of folks in the market that want to do that for what should be the better companies. You know, if there's a bunch of folks interested, then presumably that's one of the better ones that's floated to the surface. So, you know, on the whole, I don't see that there's a big hole for the best companies. It's mostly there's a hole for those guys that probably shouldn't have made it that far.
So, I mean, do you generally then agree with the proposition that at the moment good companies will get funding? You don't think there are companies falling by the wayside because however good they are, or they're good but not very good? I mean, Katie, you said you're confident the market sort of will back the right ones, but you don't think that the shortage at a later stage is actually going to hamper growth?
Guys, the guys at the back can't really hear. Can you get really close to your microphones?
Can you hear me, guys at the back? I think it's an imperfect system. And I mean, it's like the gentleman who spoke first said, Twitter nearly didn't get funded. That's a mistake of the system. So there inevitably will be companies that should be funded that won't get funded. But, you know, I think hopefully when you look at the market as a whole, it will work. And, you know, there's going to be a lag time, potentially. But, you know, long term and overall, I think the market will solve the problem itself.
We said no to FanDuel.
One thing is that this mismatch, which yes, it's not that serious, but I see it became more serious because there are more angel and more seed or micro VC starting. Is that more demand than supply of Series A money raise the bar for the company to raise Series A in terms of growth fraction and milestone. So it results in more selection, but also for seed investors that maybe a longer runway to finance. So it's not just about good company, bad company. It's how long does it take to become at that level that a Series A investor is comfortable to invest.
Okay. Question from the floor being asked: how would you each differentiate yourself? What would you, if you're selling to all these entrepreneurs out here, what would you say the reason why they should take your money? Luke, starting with you, what's Octopus got to give which the others can't match?
I think Octopus, we're in a really very fortunate position of having quite a lot of funds. So, you know, we raise money every year. Our funds are all evergreen, so there is no hard stop date for returning capital back to investors. What does that mean for you as a company? It means that we can support you hopefully all the way through the life cycle of your business. So an ideal scenario for us is to invest in you at seed stage with £50,000, to invest in you again with a couple of million as you go through super seed or into early Series A, and then again at 5 million, and then again at 8 million and beyond. And because of the nature of the funds that we have, we're able to do that. Would be one thing.
Okay.
Great question. Making the entrepreneurs, letting the investors pitch back to the entrepreneurs. So first I'd say Jamjar doesn't actually see itself as competitive. Genuinely, we're collaborators. Every single one of the deals we've done is with other funds, angels, investment houses. So why do other VCs and entrepreneurs like to have us on board? I think we are distinctive for three reasons probably. Number one, we're genuinely consumer focused, which is unusual. There's very few other places in London where you can get a fund that purely focuses on consumers. Number two, we're entrepreneurs by background. So, you know, a lot of people say that or claim that. You know, it's genuinely true here. So we try and approach stuff as entrepreneurs rather than scary investors. And number three, is less relevant for this audience, but the fact that we look at offline deals as well, that's really unusual in London. It's very difficult if you're not a tech company to find investment. The reason that we do that is because our skill set is relevant to businesses no matter what. Really, it's commercial, branding, and operational help. And so that's just as relevant for online as it is for offline. And the reason we've chosen consumer in overall is because that's what we know and that's what we love and that's where we feel we can help. So that's fine.
Thanks, Joe.
So I think Playfair as a whole is very founder-friendly towards investors. We've wanted to do that from the outset. And I'm not specifically talking about the other investors on this panel, but just more generally, the term sheets that we do offer are very founder-friendly. And I think when we do investments, we do try to choose investments that maybe have some kind of a synergy with other portfolio companies. So perhaps we're also different in that sense.
Okay. Pietro?
I think what the entrepreneurs recognize us as a element that set us apart is that we are very product-centric, and this is, from one end, the filter for us as a criteria, but on the other side is a continuous support to the entrepreneurs we back in being product-focused and product-centric in all their development and go-to-market decision.
Okay, all right. Okay, thank you. So there's a sales pitch, so you can decide which one you want to go and queue up to see later. Next question is, we're in a housing bubble in London. Do you think we're in a tech bubble? Do you think companies are being are you having to chase companies and pay valuations where you're now crossing your fingers and hoping they'll come good? Or do you feel things are still on a reasonably even keel? Luke, what do you think?
I think there's no doubt the valuations are definitely getting a bit frothier, for want of a better word. We're certainly seeing some inbound pressure as well from our friends on the other side of the Atlantic, coming and stealing away nice deals.
Because we're cheaper over here still compared to
Yeah, I
the
think
US?
there's a bit of price arbitrage going on. We start to see the rise of the cap convert, which, we've had one this morning, or two this morning, which we probably wouldn't have seen 3 or 4 years ago. Yeah.
Okay, all right.
There's a bit of froth.
You partner with other people, but you feel that, even just to sort of join the party, you're paying more than you'd like to for what you're getting.
I think there's some very expensive deals out there at the moment, but I think the truth is about valuations at an early stage. Cap convert to one side, a valuation is what you can get for it. If you can go out and raise a valuation of 20 million, there's probably a reason for that. And if you can't, then the market will price you. If you come with a ridiculous valuation, investors will tell you you're being ridiculous. If it's a great opportunity and there's other decent people that are willing to give you money at that level, then potentially that it's priced correctly. I'd say as a caveat to that, some of the valuations we're seeing are so expensive that they're going to find it difficult to raise smart money. So yes, they can get money, but is it going to be the right money? A case in point, a business came to me yesterday and said, I'm pricing myself at 6 to 7 million, and I said, God, that's expensive. And she said, yeah, I spoke to someone yesterday in Mayfair, and he said, what's your valuation? And I said, 6 to 7 million. And he said, 67 million, yeah, that's fine. There is money out there, even if you're overvaluing yourself. And I think it's the CEO's job to make sure that they take the right kind of money. But within reason, investors will tell you if you're being silly. So I think, yes, the market's expensive, but over time it will adjust itself.
Joe, are you managing to rein in your enthusiasm and sort of pull away from some of the pricey deals?
I pretty much agree with most of those points, that it is frothy at the top end of the market. There's definitely been a downward readjustment in prices, and that hasn't really trickled down to the seed stage at all. But then I think you've also got to look at the tax incentives that you have at the seed phase, which can artificially increase valuations above what they'd be in a normal tax market. And so it's difficult to say whether you will get a reduction in price at the seed phase when you've got tax schemes like SEIS or EIS.
Yeah, okay.
No, I don't. I think the market is pretty reasonable. And on the other side, more than an increase in price, maybe slight, but compared to the traction that the company come to us, our risk adjustment level are cheaper than 1 year, 2 years ago. And for example, this is in London, but also like, for example, compared to like Italy, where the single price and the pre-money are smaller, but compared to the quality of the team and what they have developed so far in terms of of product and traction, etc., is not comparable. It's much better here. So it's always to see the price versus what you're investing in.
Interesting. I mean, what's been going on in the UK, around London, increasingly throughout the UK, has been sort of going on for at least 4 years, and we're now starting to see there's been a reference already to, say, fintech and games. In terms of the next big thing, do you think it's just going to be an extrapolation of where we are already, or do you see, and you'll probably say, well, if I could see it, I wouldn't be sitting here now, but
I'd be doing it.
Exactly so. But do you see something, is there likely to be a seismic change coming up, do you think, or do you think at the moment we're in that sort of part of the cycle where it's just more refined versions of what's coming through at the moment? Anyone with their crystal ball?
So I think if we're talking about the next 5 years and what's going to be the next big thing in the next 5 years, so I think for the first time we've got 3 billion people in the world that's connected, and that's increasing at quite a fast rate. We're also being connected to hardware products, to the environments around us. So I personally think that, and this is just my personal opinion, that the big opportunity lies in kind of connecting all of that data and then using computational processing and big data and graph databases and that kind of thing to try and predict people's behavior.
Okay.
So I'll have a go. And I think me trying to predict what the next big thing is always going to be an exercise in futility. So, I think, and I've heard other VCs say this before, our role is to try and find the people that do the next big thing, not try and think of it ourselves. And there's an important point there, because one of the strategies that we have within Octopus is actually to try and back kind of generations of entrepreneurs. And what I think we're going to see over the next few years in the UK, which we haven't seen heretofore, is actually the successful entrepreneurs, so the Alex Chestermans out of Zoopla, or the Graham Bosches out of Grays, or Alex Saints out of Secret Escapes, feeding the next generation of entrepreneurs, or doing it themselves again, or their management teams going out and doing it again. And I think, 5 or 6 years ago, you didn't see that. You saw single-time entrepreneurs, they had their big win and they disappeared. So for me, the next big thing in the UK is actually that fostering that sense of serial entrepreneurship, where the guys who've done it help the guys to do it, who help the guys to do it. So for me, it's backing the guys who sat under the guys we already backed.
Okay, all right. I'll let you pass on this. I've got 1 or 2 other questions I want to come. So, Katie, is London the best city in Europe to start a tech company, if not where?
Yeah.
Okay, that's very easily done. Okay. So, Joe, if current team has no programmers, they're all outsourced, will investors see this as a problem?
I think a lot of investors will see that as a problem, because you can't undervalue having a developer, being able to have face-to-face conversations with them, and I've seen this firsthand. So.
Okay, fine. Pietro, inclined to invest in consumer or enterprise-focused companies? Which do you prefer?
We do both.
You do both?
Yeah. Enterprise with a SaaS approach.
Okay.
Rather than
All right. Okay.
heavy touch.
And Luke, what are the top 3 criteria you're focusing on when deciding whether to invest?
People, or people, market, technology, that order.
Fine. Okay. Simple. We're running out of time. I don't know if there are any questions.
Any questions from the floor?
Out the floor.
Well, you would be over there.
Go on. So I just introduced myself. I'm Richard of Reaction Video Messaging Service, Yapa. The question is, we're at that stage where we want to go towards VC investment. Do we go to the States? Because, to be honest, they're a bit more likely to be investing in things like this. From what research I've done, or do we stay in the UK? I mean, obviously,
Okay, got your question. Is it better for, because a lot of them here will say, go to the States. Why should they come to you rather than going to the States? What do you offer?
Chance to do another sales pitch.
If you're based here, I think you should find your VC partner here. If you want to move to US, you have to find your VC in US. I mean, especially again in seed stage, early stage, you want to be close, not 6 hours, 9 hours.
And seed is still local, you're saying?
Yeah, it makes sense because I mean, beyond money, if you find the right VC, is someone you want to have a conversation and set up a decent communication. So if you have 9 hours jet lag time zone difference, it's feasible, but it's not ideal.
Okay, all right.
I've got something to say on that.
Yeah.
I think it depends on the business, and you should do whatever's right for your business. In the consumer world, the UK is a really good market to test before you go to the US. Fact. So that's a reason to start in the UK. And it's a smaller system, it's less fragmented. That's a reason.
Okay, right. Are we?
Any other questions? One more before we go on? No?
Yeah, there's one more there.
There's one there.
This side.
So we had the question about relocating from here to the US. If you were a startup, for example, in Italy or Central Europe, would you recommend coming here to join this ecosystem?
It depends. It depends. I think you can, for some region, makes sense to keep the development team domestic, especially in some area like East Europe. It's great, especially the engineering part, because it's scalable, is efficient to recruit and very talented. But you want, especially for some business, you need someone in London for sales, especially, and say branding and general ecosystem immersion.
All right. Okay. Have we got to wrap it up there? I think we have.
That's the last question.
Many thanks indeed for the panel for giving you the time, and thanks for the questions.